Today we're breaking down NIKL, the Sprott Nickel Miners ETF, a niche equity ETF designed to provide pure-play exposure to nickel mining companies around the world. Unlike broad materials or mining ETFs, NIKL focuses specifically on companies whose businesses are directly tied to nickel production, exploration, and development. NIKL tracks an index of nickel-related companies globally, with securities selected based on their exposure to nickel, and then weighted primarily by market capitalization. The goal is to give investors targeted access to the nickel industry rather than diluted exposure through diversified mining conglomerates. The fund's portfolio is intentionally narrow and focused, typically holding between 20 and 35 companies. To be included, companies must derive at least 50% of their revenue and/or assets from mining, exploring, developing, or producing nickel. The index also includes companies that invest all or a significant portion of their assets directly in nickel, even if they are not traditional miners. This focus is what makes NIKL a true pure-play nickel ETF, but it also introduces higher concentration risk compared to broader mining funds. Performance is heavily influenced by nickel prices, company-specific execution, and developments within the global mining sector. The selection process begins with a proprietary universe construction methodology. This process may involve reviewing industry publications, company disclosures, and fundamental research to identify firms with meaningful nickel exposure. From that universe, companies must meet minimum market capitalization and liquidity requirements to ensure tradability and index viability. Each eligible company is then assigned an intensity score, which reflects the percentage of its revenue attributable to nickel. Companies with higher nickel exposure carry more influence within the index, reinforcing the fund's pure play objective. While the index is market cap weighted, it is not allowed to become overly concentrated. Several capping rules are applied based on initial weights to improve diversification and limit the impact of any single company. This helps reduce single stock risk while still maintaining high exposure to the nickel theme. The index underlying NIKL is reconstituted and rebalanced semi-annually in June and December. During these rebalances, constituents may be added or removed, weights are adjusted, and exposure is realigned based on updated market caps, liquidity, and nickel revenue intensity. From an investment perspective, NIKL is best viewed as a thematic metals ETF. Nickel plays a critical role in stainless steel production and is increasingly important in electric vehicle batteries, energy storage, and electrification trends. That creates potential long-term tailwinds, but it also ties the ETF to commodity cycles, global demand shifts, and geopolitical factors that can impact mining supply. At the same time, nickel miners can be highly volatile. Their performance depends not only on nickel prices, but also on operating costs, environmental regulations, labor conditions, permitting, and country-specific risks, especially since many nickel resources are located outside the United States. Because of this volatility and concentration, NIKL is typically more appropriate as a satellite allocation rather than a core holding. It may appeal to investors who have a strong conviction in nickel's long-term demand story and are comfortable with cyclical swings and equity risk. The bottom line is this: NIKL offers targeted global exposure to nickel mining companies through a disciplined, rules-based index. Its pure play focus makes it a powerful thematic tool, but one that requires a long-term mindset and an understanding of commodity-driven volatility. If you found this breakdown helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Do you view nickel as a long-term electrification play, or do you prefer broader metals exposure?